This is Justin Pulitzer. This is my weekend review for Sunday, January 17th, 2016. The markets are closed on Monday because of the Martin Luther King holiday, so we won't resume trading until Tuesday. But futures are open. They're down a little bit. Oil is down, I believe, a lot because of the Iran deal. But I'm going to go through this video, and I think I'm going to be a little bit more balanced and measured than you might see from some of the other quote-unquote gurus in the stream. I think that the tone, obviously, in the market has turned quite bearish. It's the worst start to a new year, I think, ever. So that always conjures up memories of past, I guess, tops and crashes and declines, and it kind of sets the tone. And I think a lot of people are, some of them might be getting a little bit ahead of themselves with some of their analysis, but let's go through this. I don't want to be an I told you so, but I have not been that constructive or bullish on the market for really the last year or even year and a half. And I think a lot of those chickens are kind of coming home to roost. So let's just plow through it. Let's start with my 6 market keys. I like to be consistent, if nothing else. But take a look. You can see here that we are getting near some reference volatility highs up here, this 3106. Some of these lower highs, this was, of course, being the flash crash. Let me zoom in a little bit more so I can make this a little bit more personable and relevant. So you can see we're coming into some of those past highs. IV here spiked, it kind of retreated a bit, but it's still quite high. I've been saying for a while that anything above 2520 is sort of the danger zone. You can see the day we closed here above it, we had the flash crash the next day, and this was already on the heels of some pretty nasty declines. Something that is a little bit disturbing is if you take a look, we have a uptrend line now in volatility. We have taken out a downtrend in volatility. We are making higher lows and now subsequently higher highs. That could be, and often is, a sign of a market inflection point, meaning the trend of the market has potentially changed. It doesn't mean it's all out panic mode here, but it definitely is something that I would not ignore. So as you can see, we are getting a little bit lofty in terms of IV based on some historic terms, maybe not based on the flash crash spike. So I took a look just for shits and giggles at the IV percentile that we are in with regard to SPY, and we were only in the 47% IV percentile. How is that possible with this being elevated like this? I believe that this move here, this ferocity, has distorted the IV percentile a little bit. So it's probably would normally be more than 47%, but because of this move, it has distorted it. So we are a little bit more elevated in terms of IV than I think is being told by that indicator. So I think one of the best trades on the board might be to sell S&P volatility as it rises. So if we do get a little bit more sporty to the upside, maybe getting close to these Fibonacci retracements, like between 33s and like 37s, 38s, could even get as high as 40. But if we do wind up getting some type of a more panic move, considering we've already run a lot, people always think about the absolute number. They don't always necessarily think about how we got there. You can see this ran really quickly, but this type of a move wasn't sustainable, and it wound up breaking quite hard. The fever kind of broke quite hard. So if we do get a little spiky here, the best plan in my book would be to sell S&P volatility, meaning to sell strangles or to sell puts, or really to sell some calls. I was talking to some people on the stream this week, and they said they were buying some calls as a, kind of trying to play a counter trend for a bounce. And I warned them that, if the market does rally, given that they're paying an elevated price in IV, that they may even have direction right, but they could have a losing trade because of IV compresses. A lot of people forget the Vega component of the of the situation in terms of volatility, and the change in that measure could implode a trade. Anyhow, let's move on. So if you are doing that, spreads, I think, are the better play. So that is one of the market measures. The others are, let's get into the dollar. You can see we have had a very protracted run-up in the last 2 years, and we have just been kind of consolidating sideways, kind of building out a bit of a bull flag. I've identified some range areas, and moves outside of those ranges has proven to date to be unsustainable. And you can see we got below here. It was met with a very violent reaction up to the upside. Again, kind of tested below, had a higher low, and then ripped up, got above the upper part of the channel, promptly fell back below, and now has been trying to break out again. So far, however, we are met with a little bit of lower highs, but this consolidation pattern in and to itself is a little bit dangerous, because if this does start motivating to the upside, the problem is that that is going to crush S&P earnings, which are already under pressure from slowing global growth. I don't want to get too much into that, although I do believe that this is a good opportunity, so I will go through that briefly. Excuse me, sorry. The non-farm payrolls, the jobs number, these are the kind of the 6 Fed keys, if anyone has been following me, but I'm going to just summarize them a little bit quickly because I do believe they're relevant here. The jobs numbers that everyone thought was so great the other day were a lot of temporary hires and holiday jobs. They weren't the kind of high-paying, good quality jobs, so the quote-unquote good jobs numbers really was a piece of crap. The GDP, as measured by the Atlanta Fed, has been sort of, as well as other Wall Street firms, have been in a foot race to lower GDP forecasts for the last quarter and the coming quarter. So we know growth there is slowing. The ISM was weak. Both the manufacturing and the service were below 50. That are contractionary and recessionary reads. The same with the PMI, also below 50, a contractionary, recessionary read. Durable goods has been kind of mixed. I will say this, though, that durable goods has really become a read on Boeing and the health of their plane sales, which are kind of in their own little bit of a world. Autos, and then housing has also been a really good read. And I'm going to propose that autos may have reached sort of their peak because the stocks have been getting good news. I don't really want to go through them now. You could do that on your own time. If we do that here, the video will never end. It could be like the never-ending story. But they are getting great news, and the stocks are not responding well. And I think they've been a beneficiary of low gasoline, low oil, and historically low interest rates. I will propose a picture to you that I think interest rates are declining, but for maybe the wrong reasons that they were in the past. So anyhow, the dollar here, this is still within caution area. It's been kind of building. I mean, this is a bit of a rising wedge, but the real risk is the move to the upside. If this kind of falls out of bed, I would say that will be a lot of relief to S&P earnings, but still a very precarious situation. So the dollar is also one of the Fed keys. That's kind of also why I wanted to discuss it here. And the other Fed key is the S&P 500. They don't talk about that, but believe it or not, they do consider the market. So we'll get back to that in a little bit. Anyway, like I said, the dollar has backed off a bit, but still in kind of danger mode here for a move to the upside. The bonds. Now, I have posed in the past that higher bond prices, meaning lower yields, are good for PE multiple expansion in the stock market. Why is that? Because stocks are measured on a discounted cash flow basis, and if you have a lower denominator, you have a higher end product. So just being fancy, that means the lower the dividing number, you take a number, you divide it by a number, and you get an end number. So if you have a lower number on the bottom, meaning one of those components being the risk-free rate or bonds, meaning the end product you spit out is good. A lot of TV reporters, a lot of quote-unquote these guru guests always say, oh, bonds are rallying, it's terrible for stocks, that there's an inverse relationship. Complete nonsense. I assure you, I went to one of the finest business schools in the world. I have taken multiple classes on this. I have practiced trading stocks for many years. This isn't my first time to the rodeo, so to speak, and I assure you that interest rates rising is very bad for stocks. However, interest rates falling doesn't necessarily mean that it will be good for stocks in the meantime, and I will tell you why. We are over the 2009 crash peak here, and that tells me that money demand is still very low. It also tells me that the Fed, who has gone on they've changed policies, which I have long said is a policy error, and for those of you who enjoy my Fed rants, you're about to get one as soon as I'm done with this, although it'll be a bit of a abbreviated one because I've done so many in the past. No use whipping a dead horse. Anyway, the problem here is, in my view, is there's no growth, and people are, I would say, foreigners as well as domestic people have been. First of all, let's go through that piece by piece. That one component there deserves its own discussion. Foreigners. Other countries, meaning not the United States, do not have federally insured deposit insurance, FDIC. And they have been using the strong dollar as well as a deep and liquid bond market as a place to store cash. They've also been using, believe it or not, New York and Hawaiian and Miami real estate market to kind of buy apartments. They're basically using them as safe deposit boxes with windows. But this is now the reason I believe that you have a Fed policy change. What you should have had with a Fed policy change is a continuation down. Yields should have been rising and bond prices should have been falling. What you have had is bond prices rising and yields falling, which tells me the market is starting to get a whiff of recession. They are smart. Bond traders tend to be smarter than stock traders. And they obviously looked at those 6 Fed keys that I discussed earlier, the jobs, the GDP, the ISM, the PMI, the durable goods, and they have assessed that that there is increased probability of recession, and that means that yields will fall and bond prices will likely continue to rise. You can see we are now making higher highs off higher lows. The pattern is bending back to the upside. There is some resistance short term in the 126s, and then some come in the 128s and the 129s and so on and so forth. This move, if you take a Fibonacci retracement from the high at 138.50 down to 114.88, the 61.8 Fibonacci retracement comes up to roughly between 129 and 130, 129.48. That to me would make a lot of sense. I don't necessarily know if that is going to be the be-all and end-all, considering we got pretty close there already, and being incrementally higher, it could easily shoot through. So yes, I'm not going to say that lower bond yield, that is still going to be good. I believe good for stocks that have higher multiples, but the reason for it is not the best reason. Some of that, and I don't want to get into this too much, is the high yield bond market is kind of coming apart. This is also what's causing a lot of fear and a flight to quality. Same thing with the junk. This is all what happens every time when people reach for yield. They don't really know what they're getting themselves involved in, and they get their they basically get the stuffing knocked into them. The somewhat of the good news is that we are getting close to a bit of a Fibonacci level here in the JNK, also in the HYG, and that might. I mean, there is some room down. There are some reference lows here. There's the 61.8. We'll have to see if that kind of We're also well below the channel. There should be some, I guess, of a responsive throwback. So there's probably a little bit more pain in the short term here, but I do expect there to be some type of a throwback rally for a couple of weeks. The one we all know about, and the one that is beaten at now infinitum on TV, although they were a little bit late to realizing this, is oil. Oil is being used, and I don't really care what anyone else has to say about this. My analysis has been the one that has been spot on, and until it is not, I'm going to just stick with it. Oil is being used as a proxy for global growth. There are those that say that falling oil prices are great for consumers. I will address that momentarily, but in the meantime, let's just focus on what is here. So oil, if you take a look on a more protracted chart, and this is a quite long one, from the oil bottom at $10.65 all the way to the peak at $147.27, the 2008 and 2009 crash low was $33.20, and we are now below there. The danger there means that there's not that much reference here, at least in the short term, of where, it's sort of round and round she goes, where she stops, nobody knows. Maybe I know a little bit. Let's discuss. So you have some reference lows here. This is roughly around $25. You also have some past highs from back here, which is roughly around the 26.74-ish. So I think a lot of people have been targeting that area. There's also some reference support down here in the 17s. And then, of course, if there's going to be a complete retracement down to $10.65, and this was back in the late 90s, early 2000. I believe the oil picture has changed significantly since then. A lot of this decline is because of new capacity and new ways that we have found to get at oil, meaning some major technological advances in hydraulic fracturing and horizontal drilling, and that has led to a bit of a boom in the United States. We all know about the shale plays that have been discussed ad infinitum, and I believe that there is a lot of supply. However, I do believe that there is a larger population in the world than there was back then. I do believe that China and India, for starters, are looking to become more, I guess, I wouldn't say industrialized societies, but I would say more developed societies, and they are moving more toward the combustion engines, meaning gas-powered engines. They've built more cities. So I do believe that as their demand may have peaked back out here, I do believe that the overall global demand for oil is higher than it was back here. And I believe that while we may see those levels potentially technically, I don't think that they will be sustainable long term. Just as everybody back here was saying we were at peak oil and that there wouldn't be a drop out of the ground anymore, over here everyone is saying, that we're at some kind of inflection point where oil is going to no longer be needed and everyone's going to be driving Teslas and so on and so forth. I assure you that it will take decades for that oil and gas infrastructure to change, and it is not going to just change right here, right away, right now. Just not going to happen. We're really getting kind of bombed out stochastically, although we did have a bit of a relief rally here. We're well below the lows. We're kind of getting, this was dangerously close to these lows. So those are kind of some levels to bat around. I think that you've seen a lot of this because of the Saudis pumping. I believe they want to hurt the Iranians. Also, obviously, Iranian oil is coming on, and we've had so much new supply come on here that it is definitely playing a role. I will tell you this, though. I'm sort of more of an Adam Smith market guy than I am a Keynesian market guy, and I do believe in the invisible hand, and I believe the cure here for higher prices were higher prices, as the cure for lower prices will be low prices. As prices get too low, people will start buying more or using more, and you will see a resumption in the price of oil. When that'll happen is kind of anybody's guess. You can see we're already even gapping down here in Sunday night futures. I believe that this is a response to Iran. but I would probably venture to bet that we're a little bit closer to the famous last words, right? It's sort of the end of the move than we are to the beginning. If we were really to go back down to the channel, obviously it would be much considerably lower, but we have been down for weeks and weeks, and it would not surprise me to kind of catch a lot of people short. I know that all of the big banks who were all upgrading the price of oil, that it was going to be 200 and 300 and we would never see low oil again, we're all wrong at the top, and a lot of them have kind of jumped on, and it's become consensus that oil is basically going to $10 or $20 or whatever. So I would say that if you want to start buying some oil and you want to make some investments in the future, I would start waiting to see some kind of pattern change, where instead of seeing lower highs, you start seeing higher highs with higher lows rather than lower highs and lower lows. That being said, I do believe that the best way to play in these will eventually be Exxon and Chevron. You can see while oil is at all-time lows, these stocks are nowhere near there, and I think it's because a lot of people are sniffing out that they're going to be the beneficiaries of this lower energy price. They're going to be able to snap up assets in distress from companies, that probably got overextended and are going to basically be having fire sales. These companies have impenetrable balance sheets. Chevron, and I said that I thought that their CEO, it might be my new bromance, basically came out and said he's not going to be the CEO to cut the dividend. I don't know how long, if oil goes down to $10 again, I don't know if that's going to be possible, but if oil does wind up rallying back some, it is going to be very possible. Anyhow, you can see technically in this, you have a lot of support here around the 61.8 in the breakout. I think you can use, if you want to play long against these hammer lows, if you start losing, the 79s, you probably want to be a GTFO and look to maybe play it long lower. But it seems like it's had a lot of relative strain to the market the last few sessions, which is I suppose, a good sign. Sticking with that theme, a lot of the problem for the stock market, the woes, have been global problems. Our economy, while it is still the most important in the world, is becoming less and less so by the year. And China, in particular, has become a very, very large part of the global macro story. I'm trying to get this on a better time frame. And you can see that while China never really got back to their 2007 peaks in FXI terms, it did get quite high here in a very large run-up. It was a very strong performing market, and some of these charts, believe it or not, don't even do some of the more casino-like indices like the Shanghai and the Shenzhen justice. But you can see we have been in a protracted down move. We had a bit of a rebound and now kind of back down to the downside. The good news is we are coming back into some important reference lows, sort of where this run kind of got a little bit started from. So I don't necessarily know if we get back down to these old all-time lows, although I will say at this point it really would not surprise me in the least. But if we do fill up the triangle from this trend line, since we do have a trend snap, around the 2861 does have some reference lows. So it would not surprise me to see some type of a relief rally somewhere between the 78.6, which is in the 26s, and the 28.61. I will be looking to sell some puts somewhere down here just for some type of a right or right out play, assuming the volatility does get high enough. In the short term, the big problem here is you had this big run-up, you had this subsequent crash, kind of a little bit of a rally attempt further downside. The rally did come quite high, though. It did come back up to the neckline. I did discuss this at the time, and since then it is back kind of gotten, it kind of was just listing sideways, and now it's gotten steep again. I don't necessarily know if this could be a kind of an evening star or a morning star or whatever you want to call it, an island reversal, if you will, a gap away, and then if we had some type of a gap up, or maybe we spent 2 days down here or 3 days down here and then a gap up, that could kind of signal the end of the downward cycle. I don't necessarily believe that is the case, but I am just saying technically to be on the lookout for that. Moves tend to happen when people don't expect them. We're kind of pretty far away from all of the moving averages, away from trend. And it really would not surprise me to see some type of a move back up to at least retest some of these breakdown points at some point. We may need to see a little bit lower first, back down to these levels, but we are now getting to be spitting distance. We are well below the lower stochastic line, and I would say that we are getting kind of close to some of these bombed out levels here where we may see some at least temporary relief. BABA, a lot of people have been playing this trade. I will say this. It got back up to some resistance you can see in the volume profile. This pattern was starting to look a little bit bullish, although I told people I was really suspect of it until I saw the break. And that turned out to be quite prescient. We had the break and we had the breakdown. We did get back to some levels that I have mentioned in prior videos, the 71, somewhere between the 71 and the 61.8. There is some responsive buyers here. This could have a little, obviously this could go back lower and retest the old all-time low, which I think would be an amazing opportunity. But I also would not surprise me, and I would sort of be betting on this a little bit here, that maybe we do have some type of a throwback. The big problem here for me with BABA now is you have multiple distributions of people who bought and were wrong, and this pattern that should have been bullish and resolved up has now resolved down. So all of the people who bought here are going to be looking to get their money back. You can see there, this is where the dead bodies lie. So if there was a move back up, you'd probably want to be looking to short or book. Start shorting somewhere between the gap fill and the lower part of this distribution, which is 77.77, and the gap fill here is 81.27. So somewhere in this range, if there was a rally back up, and it would be amazing if it coincided with a 50-day moving average. But all of these averages are now bent down. They are all going to be heavy on the stock, and like I said, the multiple distributions. So if you want to play for a bounce, totally understand the trade. I would probably be more interested and inclined in looking for some type of a short on a rally back up there. BIDU, I had been quite bullish on this stock for earnings. It really exceeded where I thought we were going to go by a little bit. I did say that the gap fill here was going to be kind of a spot. It did exceed that. I've said this before, and I will say it again. It often isn't as important to catch the exact high of the move as it is to sell at the right time. And, people who sold here might have been frustrated that they didn't get this, but guess what? They didn't partake in any of this down move either. So short term, again, this is really getting bombed out. We are back into some important levels. You can see we're filling some gaps. We're getting to some Fibonacci levels of importance, also some reference lows. I would actually, you can see we did get a little bit of hammer action here. We are kind of right around the 61.8. Sometimes it overshoots a little bit. I know there are some traders who play the 61.8. It has to stop to the T. I find more often than not it does overshoot a little bit. We are getting into some reference levels, so I would probably be looking for a bit of a bounce play, somewhere between the 145s and the 153s. If we did get down there a little, now we kind of rallied ahead of there. It might not be as strong support, but the bounce here, the 61.8, where it sort of kind of caught itself a little bit, was at the 61.8 from the pullback low. If you go from the flash crash low, which did get 100, it's a little bit lower at the 45s, and you can see that's the tail end of this volume distribution. So that to me, and some consolidation here. So over here, if this were to continue down, I would be interested in maybe selling some short-term out of the money puts there. You could see we also have a trend line coming up a little bit lower, the 32s. That's also the reference low here. So maybe I will revise that since we have been in a bit of a down market. I'd be more interested somewhere between these lows, the 45s and the 32s, to sell some out of the money puts for some short-term bounce. That's BIDU. One of the other key market keys is biotech. That's been used as a proxy for risk appetite for a while. You can see we stopped just shy of trend. We retested this low and did get trend. This was starting to look like it wanted to break out. Multiple tests up here. I had said to wait for confirmation. Again, turned out to be prescient. It now kind of dumped. We've taken out these lows, so we've taken out trend. It's maybe short-term oversold just because we've come down so far so fast into some reference area here. I did say the 275. I had actually been looking for a really longer-term buy here. We never quite pressed as low as we should have. Here we did have responsive buyers, so this is kind of on the right on the pass don't pass line. I don't necessarily know if it's going to be as strong of support though, since we have tested close to there. But if you want to try some type of right or right out trade, this is kind of the area to do it. If you want to play for short, I like put ratios for maybe a move down to here, which was like 247.86, so like 250-ish maybe. Maybe if you want to, somewhere between there, 247 and 250, if you want to play with put ratios near dated short term. That to me would get very extended from, kind of the breakdown, and probably have some responsive trade there. You have the 78.6 and also this reference low here. Some of the stocks in the indice, the big boys, my favorite being the Gilead, has not been acting well. I've said not to step in front of this. I am, however, going to get interested again if we do get close to these 85s. I'd probably sell some out of the money puts. I am expecting their earnings to be good. They've been good the last couple times, so maybe they're good again. And we've come down quite a lot. A lot of people always cite with these stocks how cheap they are on a PE multiple basis. The problem is that when you're in a peak earnings cycle, we all know Hillary Clinton and Bernie Sanders and even some of the Republicans to some degree have been saying that, they feel that biotech pricing has gotten expensive. There might be some regulations there, and I think that's been a lot of fear, has caused a lot of fear in this stock. If 85 doesn't hold, there's some other references around the 78s. I'll be looking to sell some puts, like I said, if this comes down hard, particularly if it's before earnings. I'd probably be playing for some type of a shake and bake. You can see we are already kind of bombed out on the stochastics. The risk here, though, I will continue to say is that we're making lower highs and now lower lows. We're not quite at these flash crash lows yet, but I do think that those will be key, at least again for a bounce. Same thing, I believe, is I hadn't prepared on talking about CELG, but you can see that kind of broke the trend here. It's on the backside of this is sort of a regression line, so naturally there was some reference support there, kind of into like a breakout area, getting close to like, I guess, the figure. So there'll probably be some responsive trade here, but this one isn't nearly as oversold, so I do prefer the Gilead in that instance. Let's get into the major market indices. We'll talk about FANG and a couple of other stocks, and then we'll kind of finish up there. But let's not BS each other. I was on a interview on that Ben Zinga show. It was on the 31st of the year. It was right around here, and I was probably the most bearish I've been in quite some time. I kind of laid out the scenario that anyone who's followed me for a while has known, and I kind of said we were on the wrong side of the mountain in a consolidation pattern that was looking like it wanted to break out to the downside. And I turned out to be quite correct. But let me show you kind of how I got to that. You had this reference low here, you have this consolidation pattern here, and then built out what I'm referring to as the mountain. We had this fall out of bed. Notice the level we lost here when it was below the 204.12. We closed just below there. Had the cascade lower, reference low, basically a double bottom, rallied up, got basically back to sort of the midline of this consolidation and sort of the epicenter of where this breakdown really kind of took place. Came back, made a higher low. I basically called this live on the my Twitter stream. If you really want to go back, I said that this was getting quite quite bearish people here, and I did think we were going to have a kind of a higher low that coincided with the pullback low. That wound up being quite prescient. We had our, I guess, rally, the Santa rally, and what made me nervous up here was the failure to really clear 210 and 211 with authority, which I've been saying 210 has been really the pass don't pass line for all-time highs. And we got basically back above there, had responsive sellers, and then again tried to rally and found sellers again. Did this consolidation, which is a little bit more sloppy, but I thought looked a lot like this. Again, being on the wrong side of the mountain, this being the demarcation point for the other wrong side of the mountain. And again, look where we lost here. Once the close below the 204.12 happened, gap down, a little bit of an attempted rally. My other stipulation was you had these basically triple bottoms here, or double bottom lows, and I had said in prior videos that once we lost that, I thought we'd have a cascade effect, and we have. However, we did have a bit of a look below. We are starting to find some support here, albeit just barely, kind of fingernail holding on to this lower part of these reference lows. We are, however, closed below a significant trend, with the more important one being from the 2009 and 2011 lows connection being significantly lower, down near these 173s to 175s, depending on how long it takes us to get there. So I will say this. We did hold where we needed to hold. Anything below 186.93, though, to me, there should be an absolute free fall down to the 182s. There's really nothing here that I see supporting other than to retest here. So this probably would be a pretty quick move. The question then becomes, and the sooner it happens, the better. Like if this just did this like Monday's close, but if this happened like Tuesday, I think that would be enough short term. I mean, look how extended we are from the 20, the 100, the 50-day. I mean, for Pete's sake, the 50-day is still up in the 107. What is this, 104? Yeah, it's still basically back up at the 104. The 200 is up at 105. I mean, even the 20 is still up close to 200 in the 199s. So I think we're getting a little bit ahead of ourselves, oversold. You can see we are first entering oversold territory. Everyone's like, oh, short term. All I heard this week was, oh, short term, we're oversold. No, we really weren't. And I was, I have not been really constructive. I will say, though, once this blue line here starts getting below, you can see that once we started getting below here, we were able to find a tradable bottom. So we are now first starting to break down there. We are getting into we are starting to get into oversold territory. So I am looking for some type of a violent rally at some point back up. I don't know how high it's going to get. It might be, if we get down here, it might be back up to these reference highs. If it starts happening here, I wouldn't be surprised to see this rally back up, maybe even as high as the 197.87. I do believe, though, that could potentially be it. It's maybe the 199s. I mean, that was really the breakdown point. I think between here, the 197 and the 199s, if we do find some stability and support, is kind of going to be the place to load the boat for right or right out short. So, like I said, 197.86 to somewhere in the 199s. That will be the place to load the boat for maybe potentially years for a short. Near term, this week, let's talk about what could be expected. The expected move in SPY is $6.24. So that would take you back up to 194s, basically taking back some of this week's range. You would basically be back up to the top of the range. If we were to lose the move, that basically takes you down to the 181s. So that would be this scenario where we do get down to here to retest these lows. So that's what's being priced in, either a move back kind of up to the top of the range, basically near where this gap fill was, or a move lower. If the move is lower, I wouldn't be surprised to see that number expand, potentially lead it to even taking us down to retest the primary trend. This, to me, would be very, very bearish for a couple of reasons. One is, the first and foremost, being it would be a violation of these double bottoms and these higher lows which we've already kind of taken out, not necessarily so significantly considering we did wind up closing above them, but it would start showing a symmetry of the market taking us down to this reference low. And then that side, if that really broke, there could be some major trouble in store for the market. And I will go over that in a minute. So this to me is really a key level. I don't always assume end ranges. A lot of people get ahead of themselves. I take it level to level. Like I said, we are at some support here. It really would not surprise me considering how bearish everyone has kind of become, and everyone knows that the market's crashing. Although I did do a poll, and over 50% of the people did say they thought there was going to be a bounce Tuesday, so it seems hope springs eternal. I really would have preferred if that number was a little bit lower, but we are, like I said, at some support. I don't always assume that we get full extension to end ranges. I want to just show you something, and I don't want to really scare anybody, but this is very, very possible. Look at the symmetry here. These lows, you got these lows. That coincides with the primary trend. A snap of that, though, would do what I have been thinking could happen for quite some time. And that would be to retest the 2000 and 2007 peaks in the 157s. That would be a pretty large correction in terms of the market, but it really wouldn't be the be all and end all of the of the bull market necessarily per se. It just would be a retest of the breakout point. We kind of never did it. I mean, I guess here we broke out. We had a bit of a retest here, but we've been up and away for a while, and it would not surprise me to see that being retested at some point. I don't know that it's going to be a straight shot here, and I'm not, we are, like I said, oversold here, getting oversold short term. I do believe that there will be an epic rally if we do get here. I would be loading the boat right or right out. I'm not the only technician who sees this reference low, who sees the trend line from the 2009 and 2011 lows. I think that this would be an amazing amazing trade. I do like put ratios or put spreads to play down there, particularly if we get some type of a bounce. But, if you want to do ratios, it's best to put those on when it's the ugliest because you're technically net short premium, and it's best to do when the IV is as high as possible. So that is sort of where I'm thinking we might go intermediately, but short term, like I said, we are at some key support. It would not surprise me to see some type of a bounce. Let's go into some other charts. I spent a lot of time on SPY, rightfully so. IWM now showing a ton of relative weakness. I want to show you. You can see we are below. We're making lower lows, lower highs. We're below the channel. We're exceeded the 1.618 fib extension on the downside from this range. Did catch it though. The body was above there, so that doesn't surprise me. Again, there's often an overshoot. We did break trend. It would not surprise me to see some type of a throwback to the 103s, but I think somewhere between 103s and 107s would be an amazing right or right out type of a short, or to sell some out of the money calls. Longer picture, let's just do the 5 years. The 2007 peaks you can see, and also over here around the 11, is not necessarily as far off as we are in SPY. We have a big trend break. Look, we did have a trend break from those lows, and we could easily retest that. It's really kind of, I wouldn't say spitting distance because it's a lot of percentage points, but it really wouldn't surprise me to see this retest. You can see there's a huge volume distribution here. This to me would be a great right or right out trade for a long. And I believe that you could probably hold that for quite large of a bounce. Qs aren't quite as weak. This did kind of exceed and make a bit of a higher high, but I am going to construe that within the context of a double top. You can see the price, though, isn't below this big kind of topping, I guess you would say, topping pattern range, so it's not really quite as bearish. We're basically getting back to the pullback lows. However, we are below the 204, 205, which I did say, 104, 105, which I did think would have been healthier if it held. So it's getting a little bit iffy. There is some room, obviously, down to that primary trend, which would be roughly around, if it happened on Tuesday, 90-ish. It's going to continue to rise. We did hold the backside of the prior downtrend line. So it's doing some things that are good technically. I would not be surprised to see this have some type of a throwback rally, but the pattern is still quite weak. Not as weak as the rest of the market, though. A lot of that weakness has come from Apple. I've talked about this being a bit of a rounded top, like the market, for quite some time. You can see it is lower lows, lower highs. We are, however, coming into a key reference low, the bottom part of a kind of a channel drawn from here. However, if we lose that, we could come into the big 61.8 around 85, and also primary trend, which, well, as we get there, might coincide roughly with there between 83 and 85. We have a big gap fill down here, which kind of got the whole market going around the 74, 90, let's just say 75. I know it seems like a lot, and it seems like it's not possible, but I assure you it is very possible for that type of a scenario to happen, particularly if the market gets weak. I don't want to call for this move here just yet. I think it's way early. We are really bombed out here, and it's sort of starting to turn. I would love to see Apple continue the weakness, maybe down into the 92s, or God willing, I mean, if we get some kind of crazy panic ahead of time, even get the 61.8 or the primary trend. I would be playing this with put ratios or put spreads. I like either one of them. I think that this primary trend is going to set up, and these reference, and the 61.8 is going to set up for an amazing move. I know there's a lot of bearishness for Apple ahead of the earnings. It's good that they're kind of getting that out. I would love to see the shake and bake flush ahead of time and then, play for a rally back up. So I'm kind of looking for that. Let's just go into FANG, Facebook. Getting oversold, which is good. I like to see things oversold ahead of their earnings as opposed to ripping up high. You can see they rallied the last couple of times ahead of Google, had the consolidation, the pullback, here the consolidation, now the pullback. Last week's video, I said I was kind of aiming for the 200 MA. That held quite well. We didn't have so much follow through the last day, but the last couple of days. But believe it or not, 91s to 93s is a key level. Below there, you're really looking at 86s, which was an important past top, also a pullback low, also close to the 61.8. I would be very interested in buying there, particularly if it's ahead of earnings, considering we came down from basically coming down from all-time highs. I think that would set up for a great right or right out long for Facebook. So I don't know. This could be it. We might have the rally back up. This is really a key level. You can see it was basically the tail line of the old range, the old support. So it supported again. So it would not surprise me again to see if Facebook did stop here. But I am looking for some type of a long entry somewhere between the 92s and the 86s. I do think that will be a good entry, at least for some type of a bounce rally. Amazon, which got way overhyped and way overloved. Did get the 1.618 Fibonacci extension, which is where I kind of said it's time to pull the ripcord. Yeah, I was a little bit early. It did consolidate here for a while. It did even get close to 700. Again, keep in mind, I sometimes say knowing when to sell is often more important than catching the absolute high. Look at where it is now. I mean, this is down significantly from that sell point. We are getting into some key reference levels, though. 50% fib from this pullback, this gap sold, pullback low to the new high. We're basically at a 50% fib and a gap fill. The 61.8 is closing in, and primary trend is just below here in the basically around 500. I would love for this continue the weakness ahead of the earnings. I think we all knew it was basically a really strong Amazon holiday season, and I do believe that this will set up for a shake and bake play for earnings. So if this does rally ahead of time, I'm going to be suspect of it, but if it continues the weakness ahead of time, I think it'll set up for a really nice long. So we're going to have to kind of see how that plays out. Strength ahead of the numbers in all of these stocks will probably be sales. If it continues down, they'll probably set up for longs. at least for some type of a bounce back. Keep in mind, these are all coming from all-time highs, basically. Netflix, I had been probably out of all the kind of big Momo stocks, I'd been a little bit more bearish. I had said that this was looking very double topish. I took a lot of heat on the stream for this. People basically called me every name in the book because they were long and not happy. And the stock has been basically a collapse since then. It's been begrudgingly, but it has been a collapse. I said the 115 would set up for a bounce. It did. It basically got up to where I was looking. I said 126s. Came back down, basically broke the range, and then they had some news here. This was basically their international rollout. Gave you an amazing opportunity to get out if you got caught in this gap. You did see some more short squeeze there, but anything below the 115 I said was vulnerable to the 110s. That basically played out. Anything below 110 I had said was 105 to the 103.88, and the 200 basically caught it here. So you have some reference support lows here. If this loses it, the 93s were the dump low from their earnings back here. It never saw that RTH, but that to me kind of, you could see where the lower end of these ranges are. I would love again to see a stock from 133 down to below 100 ahead of the numbers. I think that again would be a great shake and bake. Shake out all these chasers, get to the lower end of a very well defined range, maybe even get low here, and then set up for some type of a rally. Bigger picture, and I know people hate me for this when I say these things, that I do believe we have the potential to see 70 again at some point. The primary trend on this stock is really low here. I think by the time we got there, maybe it would coincide, but this was really the big breakout. You can see there would reference tops here, and then you gapped, and you just kind of never looked back. So it wouldn't surprise me to see this roll over and retest primary trend and retest that breakout level at some point. I don't know when that's going to be. It might not be for a while. This is still not really a crazy bearish pattern yet, although we are breaking. You can see even on, this is a very powerful pattern on the weekly, that we are breaking this channel. So when you break channels, they tend to fill up to their to their reference levels. That would be 85s here. There's also a weekly moving average coming in here around the 96s. So I would not surprise me again to see some type of a relief rally, at least for a bounce, if we did get weak ahead of the earnings. But it is starting to look a little more rollovery than I think a lot of people quite realized. Google also got quite high, got close to the channel top. Now kind of coming back mid-channel here, getting close to the gap fill. You can see it did this the last time, gapped, kind of chopped, filled the gap, rallied, came back a little bit, and then took off. Probably will be a similar type of a pattern. The best case scenario for me would be for this to come down to the channel low ahead of the earnings, get everyone freaked the F out, and play for, and back down to some reference lows, and then set up for a row long, and it would have been down so far, so fast from the high that it would set up. So that is my dream. It probably won't happen. You'll probably get the gap fill like you did here, and then get some type of rally, chop, and then take off again. Getting a bit oversold, not quite fully bombed out yet. I'm a little bit iffy below the 100 MA. We'll see where the 200 is when it gets there, but I probably wouldn't be ready to pull the trigger yet in Google. If you are a Google bull, right around the gap fill is a good right or right out trade, or if you want to sell some out of the money puts, I think that would be the better way to play it. I think I'm going to end there since we're already at 53 minutes. I was planning on doing Chipotle and Disney and Nike, but it is getting a little bit late in the hour. So I'll cover those maybe a little bit more in depth on Periscope. How's that? We'll discuss that on Periscope. Anyhow, let's have a good trading week. Be sure to follow me on Twitter. My handle is @JustinPulitzer. You can also hit the subscribe button here. You'll get video notifications when I post new weekend reviews, Periscope rebroadcasts, and special edition videos. Anyhow, let's have a good week, and cheers.